Hello, and welcome to Financial Planning Unlocked.
The contents of this podcast do not constitute a recommendation or advice from a financial planner. This podcast is based on current legislation at the time of recording and applies to English tax law. Hello, welcome to Financial Planning Unlocked. I'm Charlotte Kennedy. I'm here with my colleagues Malvi and Michael, and we're all chartered financial planners at Rathbones. Our podcast today is on income tax.
So we put together this podcast because we find that many people don't understand how income tax bands work. And it's really important for everyone to understand how this happens, because it will allow you to make the right decisions and also save you money.
Yes, and the income tax system is not straightforward. Given the freeze to income tax thresholds and salaries rising in nominal terms, more and more people are going to be paying higher rate tax on their income.
Now, generally in our tax system, the more you earn means you pay higher rates of income tax. We've got 3 different income tax bands, and the different types of income that fall into those are taxed in different ways.
So you've got the personal allowance, which is the first £12,570 of income, usually not taxed. But then you've also got basic, higher and additional rates of tax.
So basic rate of tax is 20% on taxable income up to £37,700.
Higher rate of tax is 40% on income above that level to £125,140.
And then you've got additional rate of tax, 45% on everything above that. And Scotland has slightly different rates as well.
So income tax is levied on most forms of personal income. So this includes your salary, any profits from self-employment, and P11D benefits such as your health insurance. Income tax is also levied on rental income, dividend income, savings income, and also any life assurance policy gain.
Mm-hmm. Malvi, you mentioned personal allowance. I think that's a good place to start. So most people are entitled to a personal allowance. This is the first £12,570 of income that somebody earns or receives. That is free of tax generally. I say most people because higher earners, those earning over £100,000, start to see that tapered away until you get to around £125,000, at which point there's no personal allowance left.
So let's look at an example. John has adjusted net income of £110,000. That excess of £10,000 above the £100,000 has the impact of reducing his personal allowance by £1 for every £2 of income. So, for example, the excess of £10,000 reduces his personal allowance by £5,000. So his personal allowance is £7,570. When your personal allowance is calculated, HMRC, what they're looking for is adjusted net income. So this is the total income before the application of relief such as top slicing or EIS and VCT relief. But then there are also deductions that are allowed, such as pension contributions and gift aid.
And there are some ways to help retain your personal allowance. So, for example, paying pension contributions, as Malvi just explained, or making charitable donations on which gift aid is claimed. This is something your advisor can help you with because the calculations can be quite complicated.
The tax rates we spoke about, 20%, 40% and 45%, they apply to earned income, but also importantly, interest income from your savings. There's a few other allowances that some people are entitled to, which are really important to know about. I suppose the main one is the personal savings allowance. If you're a basic or higher rate taxpayer, then you can earn up to £500 or £1,000 tax-free on your interest every year. So it's important to be aware of those because you can benefit from it and organise your portfolio to take advantage of that.
So dividend income has its own set of tax rates which are different to all other income. So similar to the personal allowance for income tax, you get a dividend allowance each tax year per individual, and that's £500 for the current tax year. This was previously £1,000. And unlike the income allowances that you just went through, Michael, everyone's entitled to the dividend allowance regardless of their income levels.
There's 3 different levels of dividend income tax, as Charlotte just said, and it's only 8.75 on the basic rate. So if you're a basic rate taxpayer, that's how much you pay on dividends.
Higher rate is 33.75%.
Yep, and additional rate is 39.35%. So a helpful planning piece as a couple is to try and look at utilising each of your dividend allowances where investment income allows, rather than have all of your investment income just in one individual's name. And as Malvi noted, the basic rate for dividend income is 8.75%, which is much lower than the 20% rate for basic rate taxpayers on other income. So that's why some individuals might take a low salary, utilising your personal allowance, and then drawing dividend income for the rest.
It's so confusing. I mean, we've studied all of this and I still struggle to work it out sometimes. The good thing is that the personal allowance, it can be set against whichever income gives the best outcome. So it doesn't have to be applied in the natural order of taxation. In some cases, it might be the most tax efficient option to use the personal allowance against dividend income. For example, where the starting rate for savings or the personal savings allowance aren't being used, and savings income can be used towards the personal allowance as well. So whilst taxes are unfortunately not going anywhere, there are things like allowances and tax reliefs that can really help us all. And tax reliefs are basically just incentives to encourage investing and gifting. And one of the ways that government try to encourage everyone to save in their pension is to offer pension tax relief. And the relief is given at the highest rate of income tax that you pay. So it's really, really advantageous.
So looking at the pensions tax relief in a bit more detail, there's two ways in which tax relief can be given. So these are often referred to as either net pay arrangements or relief at source. So net pay arrangements are offered by most workplace schemes. So the pension contribution is deducted directly from your payroll before the deduction of tax. So that amount of income subject to tax is therefore reduced and you get full tax relief at your marginal rate. Relief at source method is the other method which most personal pensions use, including SIPs, group personal schemes and occupational schemes. And how it works is contributions are paid net of basic rate tax relief, and then the pension provider adds in the basic rate tax relief on top directly into the pension. And then if you're a higher or you're an additional rate taxpayer, you then reclaim that 20% or the 25% via your tax return. So if we look at an example, so if you want to make a gross pension contribution of £10,000, you'll write a cheque or make a contribution via direct debit of £8,000, and then the pension provider will reclaim that £2,000 from the government and credit that directly to your pension. So that will total in the gross pension contribution of £10,000, and then any additional rate or higher rate tax relief via your self-assessment tax return, you reclaim directly yourself. It doesn't get credited to your pension.
Another way, or a great way of claiming tax relief alongside pensions, is by making gifts to charity. So if you were to make an £8 donation to charity using gift aid, they can claim that basic rate tax relief straight away. It becomes £10. So that's really beneficial for them. If you personally pay higher or additional rate tax, much like with pensions, you can claim extra tax relief back through your tax return that way too. We also have some other sort of tax reliefs that are out there, some higher risk investments like EIS, VCT and the like. We're not going to go into too much detail on those today.
One of the things that really bugs me is the high income child benefit charge. So luckily the recent spring budget actually changed this, didn't it? Yeah. Previously, if you're earning over £50,000, you'd start to lose that child benefit and it would get taken away completely when you hit the £60,000 mark. What they've done is sort of brought that lower threshold up to £60,000 and taper it away up to £80,000. So it's a lot more generous than it was previously. Yeah, and if you remember, this is one of the areas that Martin Lewis, from Money Saving Expert, he really campaigned hard about this, and because it was quite unfair on single income households. So where one parent is working and earning £100,000, that household completely loses their child benefit. But you could also have households where two people are working and earning £50,000 each, but still retain their child benefit. So they're doing some work to move this to a household income assessment way to make it a little bit more fair, which I think is really good.
I think that would be a really helpful change.
Yeah.
So I think we'll wrap it up there. Thank you so much for listening to our podcast. We hope that you found it helpful, and please do reach out if you've got any questions. Thank you.
This podcast has been produced for information purposes only and isn't intended to constitute financial advice. The information contained within this podcast is believed to be reliable and accurate.
Further information about tax allowances can be found on the HMRC website.
Rathbones is under no obligation to update or keep current the information contained in this material. The information contained within this podcast is believed to be reliable and accurate, but without further investigation cannot be warranted as to accuracy or completeness.